All right, so in this video, we're going to take a look at SPX weekly calendars where you can make about 106% return based on this calculation that I've done. I've done a few of these over time. It's not one of my favorite trades personally, but hey, it's a good hedge against if you have a lot of bullish portfolio things and you'd like to take things that are a little bit more bearish. So I will say I prefer doing these in more environments where the market has went up, and then you put some of these on for a possible bearish move down or like a down pop. So that's what we're looking for, a little bit of hedge off of the current positions that you have. And the returns are pretty nice when you go in and get into it. So let's take a look at the construction here. When I want to show you this construction here, we're looking at December 11th and December 8th. So the one that I am buying is December 11th. The one I'm selling is December 8th. So I'm selling December 8th, buying December 11th. And that means, to show you the days, it's going to be a Friday to a Monday. So there it is, 8th and 11th. So 9 and 12 days out when I'm doing this calendar, but I'm doing it across the weekend. So it kind of gives you that 3-day cushion. And that's just because the construction of it is a nice setup. If you do anything different, like I'll show you another construct here, where let's say we go to, I don't know, a 14 and then maybe an 11, even though it's 3 days, the way that it behaves and looks and the setup is not as clean. So that's kind of why I like the weekend ones. But again, you can play with the days to expiration based on what you like. If it's just going to depend on how you hit things. So here's one, the 12 and 14 2-day difference, or you could try the AM ones. But again, what you'll notice is that construction is completely different than when you go from here on the 11th and 8th, because right now it is 11:29. So you'll see this video probably a week or two later. So I'm looking for the 8th to the 11th. So that gives it kind of that weekend cycle. So when we're looking at this, make sure if you want the same construction, Friday to a Monday, that's what we're looking for. Otherwise, these calendar spreads can be quite tricky. They are a little bit of, difficult to set up, a lot more so than doing like an iron condor trade, because these iron condor trades, they're much more simple. You've got verticals and verticals. They're all in the same expiration cycle, whereas with a calendar, you've got 2 expiration cycles to kind of think about and look over, and you have to be a little bit more careful with those. Okay, so as we're looking for these, I've got this construction here to the bearish side. Now I'm doing the puts because of this. The put selection that I would do if you're trying to get the same construction is maybe about a 30 delta. You could do 25 to 30 delta. We're looking for a pop down, or really a spike down. And the reason we're going for about a 30 delta is because it has a chance of touching. So somewhere between this 20, 25, 30 delta, if we're aiming for this, the probability of actually touching this, option theories, go to probability of touching, is still pretty good. We're just trying to get it into that zone, and it doesn't even have to go in here and expire. We're just trying to get it to move down, and then we take it off. The reason we also like this is because we start with actually a basic nice theta that's positive. So with some days in decay, even if the stock stands still, you could still be up some money right there. And your output here is $165. So when we're looking at the actual calculation, is that if we go in just for a couple days and this pulls back to about $220, so $220 in profits on $160 of risk, plus you also might get volatility that might kick in, you're 130% profit. So that's fairly good and fantastic. So anyway, so I like going in the bearish directions with these. If you go with a bullish one, so let's do the same construction, but we'll go on the bullish side, and I will go to about a 46.30 maybe. Let's go 46.40, because I'm trying to do the same price, or the same there. The prices are pretty much the same. So here we have kind of a double calendar to some level, but these, if it stands still, you do get some theta, but it kind of kicks a little weird. So you've got this range here, and then later, if it doesn't move, you actually get into a little bit more trouble. So you could do that too, but that's a little more advanced. Anyways, if we do a bullish one of the issues with the bullish one, not that Vega is a huge issue, because you're short duration. But that theta problem, the Vega problem that's going to kick in is that as the price continues to head higher, that Vega will start to go down, right? So you've got price coming up like this, but then what's going to happen is the volatility will actually start compressing. And as you're going up, you think you're making profits, but all of a sudden you're not making anything. So it's going up right here. You think you're like profitable, but then volatility again goes down and it erases like all your profits. So this is where I like these on the bearish side a little bit more. I prefer maybe a butterfly on the upside and a calendar on the downside on that bearish end, because you get that extra volatility kick. Because if you look at the Greeks, you got a short delta of -1. So if it goes against you with price, it's not as nasty. Theta 21, so you're standing still, you're still making some theta, and Vega 41. So Vega is actually the bigger component. So if you're selling a lot of iron condors or selling a lot of vertical spreads, premiums, that kind of thing, these calendars, what they do is they help offset that volatility risk that you may have with all the other positions. So this is where placing something like this on the downside can help alleviate some of those pressures. And all we need is just a little pop. We're not looking for a meltdown. In fact, a meltdown here would not be good. Just a little passing through this area, and you can already collect almost the same amount that you paid. So it's about it could be 100% return on that investment. Now, will it work every time? Of course not. But it's just a nice construction and setup that I wanted to share with you, that if you're looking to trade these shorter duration weekly options on the SPX, this is a kind of a nice one to go through and see it to get a little bit of a downward spike. You're looking to hedge off the portfolio, this might be the way to do it. Anyways, thank you so much for joining me. Truly appreciate all the comments and fellowships that you guys write in. Check out the website for more information, coaching one-on-one. It's usually what I do is work with people one-on-one for 3 months at a time. And, continue to learn and evolve and enhance your knowledge. I will see you in the next video. Take care.